Yo, yo,
Hey, buddy,
how you doing?
living the dream. Let's go like this.
I got the festive hat on today.
Oh, looking good. Go Chiefs.
Go Chiefs. Go Chiefs.
Go. Hey, buddy,
How you doing?
living the dream. Let's go like this.
I got the festive hat on today.
Oh, looking good. Go Chiefs.
Go Chiefs.
Don't think I need to do that. Cool. Good there. And then we're gonna go like this. Shit's running. Stuff's running. So yeah, it's cool. We are live now, Hostile,
Cool.
but I will edit this part out.
Cool.
And yeah, I think it's a cool way to go. I mean, for now, it's going to be the same thing, right? It's
Yeah.
just like it's the same. It's it's 6 and 1 and a half dozen the other. But there's a bunch of these shows where they not cool. I think we're good for now. But there's like, for example, there's a bunch of these shows like Pirates of Finance and stuff. They do it live, so then we could have like regular viewers eventually commenting. I don't know. It's a very much more interactive. It's like a Twitter space, but with video.
Yeah, I dig it. I dig it a lot.
And then the other thing I was gonna say. So now what's going on? Oh, okay. I am sharing my screen. So what I'll do, let's do this. We'll go through your deck, and
Cool.
I didn't make any slides. I only have one trade, and then we'll do mine on the trading view.
Great.
And then we can freestyle for a minute too if you want, or like, hey, pull this up quick. You know what I mean? So whatever you want to do.
Yeah, dig it. Dig it. We can look at Walmart, huh?
Yeah, I like it. I like daddy like. Okay, so there's that. My biggest problem is just the Zoom bar gets in the way of all the good stuff.
No worries.
Oh,
I'm going dipping my toe in some consumer staples this week also.
cool. What are you looking at?
Monster.
Whoa, one of the best performing stocks in a long time.
Yeah, it's doing pretty well, man. It looks solid. And then obviously favorable risk reward scenario. So looks good. Yeah, there's about 5 to 10 stocks within consumer staples that still look pretty solid. And I think like General Mills, Campbell's, obviously, but the risk reward right there isn't where I want it for now.
Yeah. Cool. Looks good. I'm gonna take my stuff out. Boom. Yeah, cool. And then we'll flip through this real quick, but we're already live, so is what it is. Let me know if anything looks off.
No, there's just going to be a couple. So the gold versus, you can keep going down. Gold versus, so that one and the next slide are kind of a tandem. So there's a couple
Yeah.
tandems this week. These
Cool.
two are tandem. Gold versus commodities are tandem. And
Tandem
then,
just meaning like flip back and forth, or what do you mean by?
Yep. Same thing with banks, right? So KRE, looking at the banks, flipping back and forth, just showing what we highlighted last week. AMD, just highlighting last week's trade. That's also a tandem. And then diving into trade of the week, Monster. So
Yeah, dog. And AMD was short side money, huh?
yeah, it looked good.
Put that
Looked
on?
good. Yeah. So I closed out my puts. I actually closed them out Monday because I think we opened up and volatility kind of ran away from me. And so I was actually in the money, even though they opened red, even though the market opened green, the puts were green also. So I closed them and then was able to reopen them when we went back below 70 Wednesday. So
Nice.
yeah, little gymnastics, but like I said, AMD, I think I disclosed last week, I play with options with it just because it's so liquid. So yeah, so it's looking pretty solid.
That's cool, man. That's a good deal.
Yeah.
Yeah. So with that, let's open the formal part of the presentation. Welcome to the Men Who Stare at Charts. I'll be one of your hosts here. I'm Turtle Capital. And with me, as always, is my good friend and colleague, Larry Thompson, also known as Hostile Charts. And how's your week, Hostile? Happy Friday.
Yeah, busy week. Wrapping up year-end stuff at work and then just checking out the markets. Hectic week. I think we mentioned last week, don't be a hero. And I don't think that slogan could have hit any more home than this past week. I think if you swung for the fences Monday and then turned on the market Tuesday or Wednesday or Thursday this week, you were probably disappointed with kind of maybe where you swung if you were doing some hero gymnastics. So yeah, just interesting week. Kind of sat on my hands a lot. The only position I really messed with was that AMD one. Just analyzing some of the price action, starting to see some clearer pictures in certain areas, I think, which, this market hasn't been one that's been clear. So I think some of the clearer pictures might, who knows, the clearer pictures might point to more confusion, to be honest. So we'll see.
Yeah. And, what's funny is I was actually just laughing when he said that, and like just looking at the chart for the week, it is, we'll go through it, but so SPY, where are we at here? SPY was down, what, 2.5? Yeah, something in there. I don't see. Oh yeah, SPY. Yeah. Okay. 2.1 or whatever. But what's so crazy is like, so Monday, pretty big up day, like you said. Tuesday, gap up massively, close red, and then pretty much just, poop the bed from there the rest of the week. So, pretty, that's why, to your point, I think not being a hero really is the call. It's not about being a bull or a bear. It's about managing risk and not being a hero. And I think that's very well said. And like you said, markets are never, it's never simple, but there can be fatter pitches than others. And, this is a knuckleball, man. Low volume knuckleball is how I describe it.
Yeah.
But my man Larry's a knuckleball hitter. So with that, Larry, take us through it. Santa is still asleep. What are we looking at?
Yeah, just back to your point real quick before we go through this. I think I sent a message out on Twitter the other day just saying 11 of the 11 S&P sectors, by 11 a.m. Tuesday, that gap up, 100% of the S&P sectors were lower than where they opened by 11. So an hour and a half into trading, that was the high for the week. 11 a.m. on Tuesday was the high for the week. And so, just from there, it was carnage to the downside. And you're seeing that here play out in the tape. You're seeing, a down week and a down month, frankly, right? The intermediate trend was up. And I think this week kind of solidified back into that trend, which if you highlight it, you look at it, right? That 4,100 level in the S&P 500 was the top of the range of the trend. And then it continued downward and broke back down. You didn't see any sectors in the U.S. finish. You didn't see any major markets in the U.S. finish green this week, and just kind of highlights, some of the risk off / liquidity driven behavior in the market right now. If you highlight just go over to the next slide, we'll look at those sectors, right? The sector breakdown is it's funny because it's kind of what the whole year's looks like, right? You have consumer discretionary, communication services, technology at the bottom, right? Some of the heavier weighted sectors. The thing that really bugs me here, which I know is bugging a lot of people, I saw a lot of people posting the KRE chart this week, which we've been highlighting in our analysis for months on end, honestly, because that 60 level was kind of where we were sitting. Seeing financials kind of break down is scary to me, especially if you have technology down there also. The only thing you saw green is our old friend energy, which I still think energy allocation here makes sense to me just from a non-correlative perspective, right? When the market's going down, basic portfolio management 101, you want non-correlated assets, right? Because you want things that when everything else in your portfolio is going down, you have something that's not, and that helps you manage risk, lower the Sharpe ratio, lower volatility, things like that. So yeah, it was just true risk off behavior, in my opinion, and we'll kind of go throughout this session talking about that. I think the narrative in the media, which is kind of funny, people talking about the narrative switching from inflation to recession, but been talking about a recession for 9 months. So it's kind of funny. They'll they'll sell you whatever you're going to click on. So if we're going to click on recession this week, all the articles are going to be about a recession, right? They're going to sell you what we click on. And so the media is click driven, right? Charts are price driven. And I can't make money from clicks because I'm not in journalism. I can make money from price because I'm in the business of trading the markets, So
That said, making sure and subscribe and like Swami Research, Men Who Stare at Charts weekly video. But to Hostel's point, this is a hobby. We make our money in the markets. So here we are. Yeah, no, well said. And it's price is truth, right? The old, but that's we know that's why we're here to stare at some charts. So our first chart of the week here, looking at advanced decline and old SPY.
Yeah.
And, back to polarity, huh?
Yeah, right. That 3,900 level. I have a couple charts. I mean, every week we kind of look at the same chart, and you can see that 3,900 level. We broke below it. And back to Turtle's point about liking and subscribing to our content. Our content is price driven, right? We're coming to you guys trying to give you something outside the normal media, news driven outlets. Like, we're not going to sit here and tell you trade this before the Fed speaks to make 200%, or sell everything before this happens to manage your risk. And that's not what we're going to do. We're going to show you well-defined levels and what we think is important right now. And for me, every week I like to highlight the S&P 500, one of the most important sectors in the world, and looking at it from a momentum perspective, a breadth perspective, and then overall price perspective. Being below 3,900, bad news, right? Momentum being below 50, not great, right? We might bounce at 40, but overall being below 50 is not good. Typically in a downtrend, you'll see around 60 is the top for the RSI range. And that's kind of where we were sitting. That 60 is kind of where we kept getting denied on an RSI range perspective. Just classic downtrend behavior, in my opinion, right? You'll see later in the presentation, we highlighted last week, you can just draw a fat line connecting those lower highs, right? It's not too much of rocket science here on that perspective. From a breadth perspective, we're kind of teetering, right? We haven't broken down yet, but we'll highlight in some later slides why I think breadth will continue to follow through and follow price. But overall, it's just not an uptrend.
Yeah,
right?
Certainly. And and basically, not that there needs to be a point, right? But I guess so clearly the price action of SPY, we're resting on this key level, right? 3,900, or actually, excuse me, we're below a key level of 3,900. And then on that, also the breadth level is right at a key level. And how do you think about that? I guess is on the breadth specifically. Like, so you're looking for follow through. We're looking for follow through or lack of follow through. Is that basically what to watch from here?
Yeah, I'm looking for confirmation from breadth, right? So we're looking for it to confirm lower prices. And we'll go through next couple of slides, and you'll kind of see why I'm not overly concerned about whether or not breadth holds up here, and whether or not that's like, oh, this could be a bounce, right? We could bounce from this 3,900, because if you look at the next chart, right, look at the components that make up breadth, or that make up price, right? And one of the largest component of the S&P 500 is Apple. And what did Apple do this week? Apple, on a relative basis, broke below its June low on a relative basis. To me, that's pretty significant. If the poster child for the market, relative outperformance for who knows how long, is kind of struggling here, right? Last time it kind of ran up, RSI couldn't get above 70, kind of showing a failure swing top. We're starting to break below that June low. So does breadth really matter if Apple's going to continue to underperform? If the NYSE FANG is going to continue to underperform, if the large mega cap stocks, the FANG stocks, are going to continue to underperform, breadth in a market cap weighted index isn't necessarily going to matter. And that's why if you look at our previous videos, and you can go to our Twitter pages, what have you, we've been preaching equal weight allocation, because that simply gets you out of some of these overweight areas that are underperforming the market. right? Dan Russo does a great job with Potomac Research highlighting exactly that, right? He highlighted a couple weeks ago, maybe a couple of months ago now, like if you're buying market cap weighted, you're buying communication services at a weight higher than utilities and energy, right? And so that's just one of the things where breadth to me is becoming less significant if the bigger cogs of the wheel are breaking down.
Right. It's the old, would you rather fight 100, duck-sized horses or one horse-sized duck? And Apple is the horse-sized duck. And
Sure.
if all the duck-sized horses, move in unison, then maybe we could rally. But all we need is one horse-sized duck to go down, and we're going down. I don't know. Not very well said, but you know what I'm saying.
Yeah.
So Fang, very important. Here's
Here's
like
10. Here's
Yeah.
10 duck-sized horses or
Exactly.
horse-sized ducks, right?
exactly. If you include all share classes, 10 for sure.
Right.
Yeah. So what do we see here?
Yeah, we're just highlighting this downtrend, right? We highlighted this last week. If I mentioned if we could get above 5,000, that would be great. But if not, that we're setting up for a lower high. And that's exactly what happened this week, right? We had that fake out on Tuesday. And from there, the market just continued to go lower. On an RSI perspective, you can see momentum continues to struggle to get above 50. And that to me is just more characteristic of pressure from the bears on the bulls, and bulls cannot get control of this index. And so if we can't get control of the largest stocks in the world that make up the US stock market, it's going to be a hard battle to fight for the bulls. And so that's all we're highlighting here, carrying on from that breadth discussion. Like if this continues to go down, it's going to be hard for those market cap weighted indexes to go higher.
Yeah. It's interesting just looking at while you were talking about the market caps, or the weightings in SPY. I hadn't checked it in a little while. And it's interesting since, Google and Amazon have had such worse years than Microsoft and Apple, how much bigger Microsoft and Apple have become this year. So now, as of today, I think on the close, it's like Apple's 6.3% of the index, Microsoft's 5.7%, and then Amazon's 2.4%, and Google's 1.6%, but that's only one share class. But the point is that, like, remember when Amazon was the biggest company in the world? That wasn't long ago, so things are moving fast out there, ladies and gentlemen. And on that, some advanced decline lines.
Yeah, looking at breadth again in a different way, right? Trying to highlight, although breadth might not be breaking down yet, what's it look like it's heading to? And you look at the small cap, mid cap, I have 3 market classes that make up the S&P 1500, right? And I have them in order from largest to smallest, and smallest normally leads the way, right? It's like turning a car versus a cruise ship. S&P 600, it's back below its 100-day SMA, which on breadth, I just put on a moving average just to kind of help define trend. You can see that they're flat, right? So the point of highlighting that is to see that, over time, breadth has been going down, the slope has been down, but it's been relatively flat, which leads no conviction to breadth. So if price is breaking down, my number one conviction, and breadth is kind of mediocre flat, right? The weight of the evidence is down. And that's what we're highlighting here. And you see today, we have mid caps broke through, S&P 600 already broke through, and then today S&P 500 kind of broke through that 100-day. So intermediate term, that the breadth is getting worse, and this might be signaling continuation of the recent break in 3,900 on the S&P 500.
Yeah, and potential follow through for more potentially.
Exactly.
Stocks versus bonds.
Yes. So this gets into the next segment of risk off, right? What does risk off look like? And for guys like Michael Gayed, who've created ETFs around risk off, risk on, it's been when there's risk in the market, people are buying stocks. When there's risk flowing out of the market, people are buying bonds. And what's happened this year is there's been a correlation between stocks and bonds. And that's what's killed a lot of 60-40 allocations. What I'm seeing here, and what I really want to highlight with this chart, is the fact that, stocks were in an uptrend versus bonds, and that trend looks like it's breaking. Momentum on RSI is breaking below 50, And then the last thing I want to highlight here is if you look at a 4-week basis, so I was basically averaging a month for the rate of change, 4 weeks. This is the worst 4-week change since COVID in the ratio of stocks to bonds. And so for me, this is highlighting true risk off behavior. This is what, when the 60-40 kind of saves you, right? If you have that allocation, this is what you would have expected. Okay, stocks are going down, but this is where my financial advisor is going to make some money because he's had me allocated to bonds. And that's where I'm going to stay with him. We haven't had that this year, and we're starting to see that shift. Why are we seeing that shift? We'll highlight that in some further charts, but I think it's because of the pressure shifting from inflation to recession without even looking at a single headline. That's what these next couple charts are showing us. What are your thoughts there, Turtle?
Exactly. I think you said it very well. And I think that it's interesting how you can come to a similar conclusion of the, Guyad is a great example, right, of like some, but again, like you said, any 60-40 long only financial advisor is in a similar boat where the 40 is just not helping the 60. And that's what's the point of keeping money in bonds if they're not going to help as a hedge? I mean, now they pay a little bit of interest, but up until this year, they really haven't, they don't really pay anything. So I think you said it well. It's interesting to me how I really like the rock component of this chart at the bottom. I think it's very interesting. And I think that it's interesting how you can come to the same conclusion from many different perspectives, whether you're like a correlations guy, you're watching the correlation between stocks and bonds or dollar and bonds. And to your point, that's something that has been identified by looking at, just a little bit of correlation analysis, confirming kind of the same thing you're saying, that all of a sudden bonds are acting risk off. All of a sudden bonds are acting as they traditionally have, especially post 2000. And then to put the cherry on the sundae, it's, that I think that hypothesis is very, that's a great hypothesis. And the narrative is the focus shifting from inflation, which has driven everything to recession, right? And so yeah, I think it's
right, either the R word or slower growth, right? Whatever word you want to use for what's
right. Not like in a politically triggered way, recession, but the word, it's figuring, it's focusing more on, like you said, the dark clouds that, are forming. Are they, is it going to be a thunderstorm or hurricanes? Like it's hard to say, but there certainly are some clouds forming that we should wrap this kite sailing contest up pretty quick. Anyway, and to your point, why, right? Like you alluded to a couple slides ago, nothing is more important to be watching with regards to this as probably this chart right here. So tell me more about what you're looking at when it comes to the dollar.
Yeah, the dollar, I posted earlier on this week on Twitter, I posted the weekly chart and I was like, this weekly candle has a long way to go before it closes. And in general, you know this, I don't really enjoy when people like make fun of journalists and like attack them for like, oh, sentiment, they're the best sentiment indicator. Okay, go back to February 10th, 2022. They put an article out saying the stock market's going to go down. No one's highlighting that, right? No one's highlighting that they were right. But people will highlight when they're wrong, and their job isn't to give financial advice. Their job is to publish papers. And so I would like to see those same people get smacked in the face again, because I like to see them be kind, right? Just be kind to people. It's a different job, right? And so I think, I just think it's still too soon to give way for the dollar just to get destroyed. I still think it's too soon, especially if the UUP is above 28. I just think, this is a perfect level. Maybe you add to it, right? What happened last time? We had we had this doji candle, and then we had a hammer candle off of 28. We rallied strong, right? And that's what it may be setting up for here, is another rally to the upside, right? When everyone is poo-pooing on the journalists, right? That would be another contrarian signal, is to go contrary to what, what's been occurring, and kind of actually go to the underlying trend, which to me is overwhelmingly up. This also really limits your risk, right? buying the failed breakouts, if you could call this a failed breakout, but buying it now, you can buy it at 28 and that's your risk level, right? You know, if we're going below 28, we're probably going lower. But if we're above 28, you have to err to the side of the underlying trend, which is up. So for me, that's kind of how I'm looking at this. If you want to get a little more tactical, RSI on a weekly staying above 40 is kind of important for maintaining that RSI range of an uptrend, right? Typically 40 will act as support for an uptrend. So that's kind of how I'm looking at this. And especially for allocation purposes, I think the dollar makes a lot of sense. And so just a chart we wanted to highlight, and we try to highlight often because it's very important to the market right now.
Yeah, I like it. The to your point, actually, so between the two, you mentioned, so you bring up a great point from a portfolio construction standpoint, is like diversification, right? So incrementally, you're adding this position to a portfolio, let's say, you know, Walmart or Johnson and Johnson or Coca-Cola. How much diversification does it actually add, right? And you know, for your average like growth fund or ETF, not much, generally speaking, right? Energy, like you said, is the least correlated to SPY sector, generally speaking, over long time horizons. Yep. Between the two, though, right now, dollars versus energy, within SWAMI, we recently took out the SWAMI model portfolio. You know, email at info@swamiresearch.com if you want to learn more about that. We recently took out energy because we think, well, you know, just kind of concerned about the recession prospects. Yep. But we haven't taken out dollars, right? So just thinking of, you know, that's kind of how I'm thinking of it. One other quick comment, and just these are just comments, whatever, who cares? One other quick comment on that is that regarding use of the word trend, right? So if you like to look at a 50-day moving average and that's how you look at trend, right? In general, I think, you know, Larry and I both ascribe to life is easier following trends, right? That's not controversial. And life in general is easier following trends. But if you're using like a 50-day moving average, the point is, as you cross asset classes, some are slower moving than others. And so what I'm getting at is guys that are very good at this, from what I understand, dollars, and from what I've back tested, dollars pull that trend back a little bit when you're thinking about dollars, right? Meaning use a longer moving average because currencies just don't move like stocks, right? So anyway, to Larry's point, I'm with you. I'm concerned about strength in dollars, which is generally weakness in risk assets. With that, the other or another, you know, very important barometer of fear and risk in greater financial markets is the Treasury bond market or Treasury yields, and look how well that lines up with ARK or an inverted chart of ARK. Yeah. So tell us more on what you're looking at here, Larry.
Yeah. So, right, I dig into charts, not narratives, when I'm trying to find what's going on in the markets. And one thing I like to look at is I like to look at yields, but I like to look at yields along with a growth proxy, right? So I want to see when they're correlated and when they start to not correlate. And what we're seeing right now is if you use yields, right, I'm using TNX, I'm using the 10-year yield as my yield. And then I'm using ARK inverted, ARK as my growth proxy, right? And so ARK inverted would typically correlate with yields, right? Because as yields go up, growth gets hit. What we're seeing now is we're seeing yields go down, right? We're seeing yields go down, but we're also seeing the growth proxy, which is ARK, go down. What's that indicative of? Slower growth, AKA recession. So that's what I really like is I actually got a comment on Twitter while we were recording this about like, this chart doesn't tell the story. I mean, that's why I like charts. They tell you the story. This chart is telling, this chart is telling you the story that, you know, they're expecting ARK to continue down even if yields come down, which tells you the growth factor for yields coming down is slower growth. And so that's where, to me, it's getting interesting. And that's where, you know, if you start to categorize this recession as a bear bear market recession versus like just a normal bear market, that's where the significant drawdowns increase a lot. And so that's probably where you saw some of that panic this week or selling this week is because of that. And so what I was just trying to highlight here is that recession story within a chart.
Right. And something that something that I've thought about, and we'll see, and kind of how I hate, we'll see what happens, but something I could, let me just paint you a picture, right? Like yields start coming down. That's happened. I think we've talked about this. Yields come down. The immediate reaction function is people, buy tech because yields are coming down. And that's what, that was the narrative of why tech started going down to begin with in November 2021, right? Yep. When yields started going up a little bit. But the point is that, but no, profitless tech is not what you want to own in a bear market or in a recession anyway. So I guess what I'm painting a picture that, maybe there's a scenario where at first tech gets a bid from yields rolling over, and then people, really stop and think about why yields are rolling over. But anyway, what do you do with that? GLD DBC. So basically, yeah, gold starting to show some relative strength within the commodities.
Right, which gold's risk off. It's a safety bet. And so this was a chart from last week I highlighted, and then I kind of zoomed out this week. So we'll go to the next slide. And you'll kind of see this, to me, is a critical point for the relationship between gold and commodities, right? So within commodities, you have, right, I don't have the technology or the tools yet to pull out gold from commodities and make it a 1-to-1 exact ratio at this point, right? We're looking at this for trend. We're not looking at this for like the extreme, most tactical sense of the term gold versus commodities. I know there's an overweight in DBC to energy. I'm aware of these things. The point here is just to kind of show the significance of the uptrend and then the significance of the downtrend and then where this trend is currently headed, right? So obviously strong downtrend since the peak in the market because of, the implications of inflation. That's being highlighted by the sheer outperformance of commodities, which to a lot was surprising. But then you're starting to see gold made a higher low on a relative basis, and it's starting to continue its way up, right? And so that to me is indicative, like we highlighted last week, of that safety, of true risk-off behavior. And so, yeah, this may just be the beginning. We're going to continue to monitor these levels and kind of see if this has a play, but it's just something, a piece of the puzzle that I was analyzing to kind of see, okay, people are starting to buy gold. Why is that? People are starting to buy gold in a way stronger pace versus commodities. Why would that be? So energy, right? So versus energy. I guess I could look at this gold versus energy possibly, or gold versus lumber, right? Is a super common way to kind of analyze some of this. And so, yeah, it's just piquing my interest, especially getting over this critical level.
Right. Yeah. And again, it's multiple channels telling you the same thing, right? And in some ways, right? So, gold likes lower real yields, lower real rates. And, that's more confirmation potentially of that trend, right? Which is, long end of the curve really is coming down now. Because, forgetting, we've over-extrapolated, I've used this line probably a couple of times on the show, but we've over-extrapolated every trend since COVID started. So, what's one more, right? So, and now we're, maybe over-extrapolated the inflation trend, and now that's turning into a recession trend that we can over-extrapolate, but we haven't even started that yet. So, on to regional banks. What are you looking at here?
Yeah, so looking at regional banks, this will be one too. This is our chart from last week. We kind of highlighted the failing of momentum and, this potential, keyword potential, head and shoulders pattern. I don't really care about pattern terms and all this, right? I care about 60 being an important level. I think everyone agrees that 60 was an important level. And we highlighted that in our work. And if you go to the next slide, we'll see, where are we now? We're below 60. Yeah. Right? We're kind of taking out that neckline. This doesn't mean the world's ending, right?
Right.
I've been fortunate to learn from a lot of great technicians via in-person phone calls or just watching some of their content. And going to highlight Dan Russo again. Like, he's taught me a lot from afar, just about gradually position yourself. There's no reason to do things at extremes, right? Human nature likes extremes, but we should probably be somewhere in the middle. This doesn't mean take all your mom's 401k and short banks. It's interesting to highlight that banks going down is not a good thing, right? Every bear market includes financials breaking down, right? We don't have bull markets without financials going up. And so that's one of the things where, okay, KRE's breaking down, very sensitive to community growth, very sensitive to rates. And so seeing the fact that rates are going down and banks are kind of breaking down, but other things, bonds are going up, to me, it's a tricky situation where I think there's more room to the downside for sure.
Yeah. And again, banks like higher rates, right? And because more margin, net interest margin, whatever. And again, so this speaks to these guys rolling over. That's point yields lower, right? And again, we're just building mosaic. It's not about, nothing's for certain. It's not about finding some grand theory of everything, but definitely the weight of the evidence is to rates coming down and what goes along with that, which is potentially even the R word.
Yeah,
AMD, our great trade last week. Sorry, go ahead, Haas. I didn't mean to cut you off.
Yeah, I just think too that people, soon as a correlation gets to where everyone and their mother knows about it, right? Oh, the reason stocks went down is because yields were up, right? It's hard. That relationship is super easy for everyone to understand. What people might not understand is that the rate of change is oftentimes much, much more important. The rate at which yields change is what was significant, right? And that's something that like physically is almost impossible to happen again, based on what the Fed's telling us and rates, based on what bonds are telling us. Like, that rate of change might not continue, but yields could continue to go up at a slower pace and still bring pressure to the market. And I think people just thinking that correlation of yields down, stocks up, right when people think that correlation is set in stone is when it changes. Just like people thought the relationship between bonds and stocks was set in stone. Just like people thought the relationship between gold and inflation was set in stone. You have to stay on your heels for those correlations, because at some point they run out. And so that's just my last piece on that.
Yeah, that's a great point. It's a great point.
Highlighting AMD, this was our trade last week. I just kind of wanted to show you guys where we were at with it. This was last week's chart. If you go to this week's chart, you see we were down about 4.5%. So we made a little money, especially in the common. Like I said earlier, kind of finagled some of the options positions, but still in this trade. 65 is an interesting level from a tactical perspective. It's kind of served as support short term. So we'll kind of see how that functions here, whether or not that's going to work. I still like the fact that RSI continues to get denied at 50 and it's making lower highs. I like the underperformance on a relative basis. I just still think it looks pretty good here, especially if you have exposure to market cap weighted and you want to, take on some tech, right, which is pretty heavily weighted in S&P. This would kind of be a good way to position your portfolio. Last thing, my trade of the week this week is pretty boring. Just highlighting Monster, right? So that's the stock that I'm going to be long, right? So I like Monster here. I like Monster above 100. I think you have pretty well-defined risk in this stock, right? 100 is kind of the risk level I'm looking at here, right? It's a market cap of 52.6 billion, trades about 6 million shares in volume. So tons of volume, large cap stock. It's within the sector of XLP, consumer staples, beverage company. And what I like about this is, one, the relative performance is off the charts, right? So it's making new highs, 52-week highs on a relative basis. It might be all-time highs on a relative basis. We have this similar to the dollar. You have the breakout and then back to the point, back to the base. will we see polarity here, right? Will we see 100 turn into support? That's the goal here. We want to see 100 turn into support and serve as a springboard for the stock to continue to the upside. If you want to be fancy with patterns, this is a big base forming. You could maybe even call this inverse head and shoulders if you see those two shoulders and then the head at the bottom, right? What have you. To me, it's about it being a big base, relative outperformance, and a risk reward that's in our favor. So I like the stock long over 100. With it being, 104 kind of being where it's gone, my target for this would kind of be the base of this pattern. So looking at like 76, right? So that'd be about $20, $24 to the upside. So maybe 125 as your target here. But for me, I'll just stay in as long as it's above 100 and outperforming on a relative basis. Even if it goes sideways and the market's going down, this is kind of a name I would stay in. Kind of similar to our trade maybe like 2-3 months ago when Turtle got into Constellation Brands, right? Constellation Brands went sideways, but we were generating, a point of alpha we were generating, 100, 200 basis points of alpha over the course of that trade, which, protecting capital and preserving capital in a downtrend is a great skill set to have.
Yeah. Unfortunately, my wife tells me our kid can't eat alpha. So we need real returns here. in the Turtle household, but yeah, no, that's I love it. I love the consumer staples idea. Look at that relative strength, right? So I mean, I guess I'm really asking about that before we jump to the next part of the presentation, but is it's almost like that. I mean, how much trees don't grow to the sky, right? I mean, do you ever worry about something becoming too, I mean, I don't know, it's just it's since it bottomed in March, April, it's just more or less just been a great consumer strength has come a long way since the summer.
Yeah, for sure. But if you think about it, this stock's gone nowhere since March of 2021. So if this stock was going straight up, I'd have some concern, but we have that breakout that failed and it's back at support. So the risk reward, right? If I was trading from a relative strength perspective, it would be different. But the fact that 100 is just sitting there for my absolute price perspective, that's where I really like it, right? Like I could pull up charts right now that have much better relative, that have even better relative strength. And, on a absolute price basis are going up even more. Like I think, like if you pull up Campbell's Soup, for example, right? Like Campbell's Soup looks amazing, but I don't know where to get long it right now. Like I don't know where to get long Campbell's Soup. And so I know where to get long Monster. I think the risk reward ratio is better in my favor on that trade. So that's what I'm going with.
Love it. Love it. No, well said. What is it? CPB?
Yep.
Let's go like this.
That must be daily. Struggling at 57.
Yeah.
Look at that week.
Let's go like this, and then let's go like that. Let's go like this. CPB. Cool. Yeah. So, if I relative strength site, it's tricky with the Zoom bar to throw a relative strength.
Yeah, but obviously it's outperforming because it's rocket, right? So but I don't know where. Like, do I get in? See if this pulls back to. If you zoom out on this, if it pulls back to, I think it's 52, 54.
Yeah.
Right. If you look at like 52, 54, I think on that level, if it pulled back there, then it'd be similar to that monster trade. But yeah, right now, this is one where I don't, for me, don't necessarily know where to get long. There's a little more risk, right? If say I get long at 54, right, that gives me like 7-8% to the downside where, in this other trade, I have like a couple cents to the downside. So.
Yeah, no, totally makes sense. I like it. And no, again, and lastly, I'll the consumer staples in general are those are duration assets generally, right? They're long duration assets. They don't love rates going up. They prefer rates going down. And that's that is, they're heavily indebted generally, or they're generally levered. And so XLP, I think, is a good hunting ground to Hostel's point. And then you could buy the index or you could buy the relative strength, right? And
Yep.
so that's I think it's a great call. I like MSTR or excuse me, Monster MNSTR. Wait, whatever the MSTR. Yeah, whatever. No, MNST. That's what it is. MSTR is MicroStrategy. Anyway, all right. Cool. And so I don't have any formal slides for you guys today. I was just gonna pop through a couple charts. I closed out. We're I think we're 16 and 12 here on Manustera charts on the been tracking the trade, but I'll give you the updated scoreboard next week. We closed TSLQ. TSLQ for the uninitiated is short Tesla, right? Nice, strong green bar. I closed it today in that in the Manustera charts model trade account. And then the only one we still have on is J&J. Here's how we're looking there. That's the J&J chart, kind of consumer staple-esque. It's a and they're actually spinning out a consumer staple brand, but they are a XLV component, medical, they're a medical device and drug company mostly. AAA rating. So anyway, holding on to my J&J. Any thoughts here?
Yeah, I mean, healthcare's in terms of the healthcare space, right? It's not necessarily outperforming, but in terms of the market, it looks, it's kind of going sideways while the market goes down. I don't have a ton of crazy thoughts here. I mean, it's kind of messy for like it's not breaking out. Well, it's not breaking down, right? Like low volatility, relative strength. It continues to perform well on a relative strength basis. No real reason to close it here. I wouldn't necessarily add to it. I would just let it go on.
No, fair. That's similar to what I was thinking.
So
here's my trade.
What was your basis on this? What was your entry? Because Johnson was it 160? I think it was.
I believe. Yeah, I think it was. I just did it. I think it's. I just was looking. I think it's in the 160s. Yeah.
So it's up 10%. So.
No, we were up. I was thinking about closing it out, but like you said, it's not breaking down. I got to be exposed to something, and so we're hanging in. What else was I going to show you? And then the trade for the week was WMT, right? So again, similar, right? We are not, this is not AMD, right? This is a much more conservative play. This can do well. Clearly, people are shopping at Walmart. We don't need to be in a robust economic environment to shop at Walmart. Quite the opposite. In fact, Walmart can, pick up customers in a poor economy and et cetera. We're not here to talk about fundamentals. Down this week, right? When I switch, I'm going to leave it on weekly, but if we did switch to a daily, it clearly has had some weakness. This is not my favorite technical setup, where it's like the stock is kind of like careening back to like where I think support will be, because I don't know, it's just hard to like know. I mean, I don't think I'm as good at finding support as you are. And so a lot of times it's like, oh yeah, I think we should find some support here at 140. I put my stop loss at 141. I think we should find some support here. But that's just what I think. And a lot of times, especially when there's momentum on the downside, it can slice right through that. That said, so that's what I don't like about it technically. What I do like about it technically is if you zoom out, that we're clearly in an uptrend here. I like that if you're looking at it from a trading range standpoint, to me, this is coming to the bottom of its trading range. And so at the duration I'm looking at, so that to me, that gives us a tailwind, right? If something's at the bottom of its range, it's more probable you'll make money than if it's at the top of its range. And then the last thing is, again, I'm not a fundamental analyst CFA character, but I certainly like to think about some fundamentals. And so fundamentally, right, what's the macro setup, blah, 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 again, what we've just been talking about, rates down, recession potentially. So this is one that fits, this fits well in that mosaic. what do you think about all this? So that's my trade, 141 stop loss. I put take profit at 148, but I don't really think about it that way, right? We'll just try to make some money and then we'll just reassess. Clearly more upside than downside, but yeah, what do you think about this trade? Hassel?
Yeah, so back in 2008, 2009, when the market kind of really struggled, this was a strong outperformer. Trying to see what other time frames in which 2001 to 2001 to 2003, it was a strong outperformer. So yeah, right. If the basis of kind of what we were highlighting today was, slower growth, recessionary pressure from the market, right? Risk off behavior, I think this name would outperform the broader market. So with that being said, yeah, it might not be the best place to get in. It's not the prettiest stock from a, weekly standpoint. But if you zoom out to the monthly on a longer time frame, it's kind of sitting in a bull flag pattern, right? It's kind of sitting from this, you're right. If you look at your lower end being like 120 and your top end being like 150, I know that's like a pretty big price range, but it's just kind of sitting there. It's just kind of sitting in that price range. So this doesn't bug me from that perspective. I think that you said 141 was your level.
Yeah.
Well, let me just zoom in here real quick.
Yeah. Where would you draw it? Tell me that too.
Yeah, I'm trying to see.
Looking at another chart real quick while you're pausing for a second. The other thing I don't like is so we got RSI breaking. These are just, again, you're weighing evidence, right? There's no one data point that, unless it's like, Blue Horseshoe likes Walmart, that's different. But I don't get that call very much. So mostly it's RSI breaking back below 50 on the daily. And then, it just looks to be, it's actually 9 of the last 10 days it's traded down.
Yeah.
I don't know what you make of that.
But, right, like you said, if it's at the bottom of its trading range, it's because why? It's been trading down. So,
yeah, right.
Like, to your point, right, you're setting up for what you think could be the bottom of its trading range. That's right. So that supports your thesis, right? So if it didn't support your thesis, I'd be more worried. I like 138, 139 as a stop here. I just zoomed out a little bit. If you look at the bottom end of its monthly candle last month, it was 138 was the bottom of that monthly candle. And then looking at the weekly, you can see there's a lot of price action. There's a lot of memory in this range for Walmart. So that's kind of where I'd probably set a less tight of I'd probably go to 138 personally for me.
Yeah, pretty tight. Yeah.
Yeah, I like that level. But yeah, I think especially for kind of the market we're in, you're not just going to sit here and point out, amazing uptrends breaking out of bases. I tried to find some, it's kind of tough right now.
Yeah, right. And it's we want to ride trends. There's mean reversion within, so longer term, we want to ride this trend of clearly since that awful Q2 print, it's had a nice rally. And then, if we want to ride trends, but then within the trend, it's mean reverting, right? So it's at the bottom of its range of, according to me. And then it's, so it's more likely to mean revert within the range and then continue riding the trend. Anyway, that's me painting a nice story. We'll see what happens. I do hear your point though. It's a pretty tight stop. I've got a trend line there, on the, in my crayons. So that's why I put it there. But we shall see. So anyway, I like Walmart above 141. That's where I'm going to place my stop loss. And look, you can have multiple stop losses, right? You don't have to, trade in blocks, right? It doesn't have to be, and we're going all in, all out. But for the purposes of a show where you prognosticate, it kind of does. So 141 is my stop loss there.
I like it.
Got the machine open. I want to get you back to the wife, but any other charts we should pull up while we're here? What else have you been looking at?
Honestly, that probably highlight what we've looked at. I tend to, just for those that might be new here, I tend to look at weekly charts, right? I kind of have a positional trader perspective. I'm not a big daily trader. I don't do a ton of daily work. So I think after this, I'll be diving into some more of my weekly charts. And if anything comes up, maybe we do some, we might pop out some short videos this weekend for you guys to see. But other than that, yeah, thanks for tuning in. Hope you guys managed risk well. And yeah, follow us on Twitter, YouTube, all the thingamajiggies to, see some of our content.
That's right. That's right. Thanks for turning in to this week's The Men Who Stare at Charts. Appreciate you coming out. Have a great weekend. And